Most people don't fully understand the difference between term life and whole life insurance. But term and whole life serve completely different purposes, and getting the wrong one could cost you thousands in the long run. So let's break it down. Hi, I'm Anna Marino, a licensed financial professional. On this channel, I simplify protection and retirement strategies so you can make confident financial decisions. Term life insurance is temporary coverage. You can choose a term coverage for 10, 20, 30, or 35 years, depending on the carrier. And if something happens during that period, your beneficiary receives a payout. So term life is typically ideal for young families, mortgage protection, or income replacement during working years. Now, some policies today offer optional riders such as living benefits. Now, these riders allow access to a portion of the death benefit under certain qualifying health conditions. However, availability and terms vary by policy and carrier. Whole life insurance is permanent coverage. Now, it is designed to last your entire lifetime as long as premiums are paid. It's often used for long-term strategy planning, legacy goals, and conservative financial strategies. Now, let's take a look at the key differences between term and whole life insurance. Cost-wise, term is more affordable. It's a lower cost, whereas whole life is higher due to permanent coverage and the cash value that builds over time. Duration. Again, term, like I said, is temporary. It could be 10, 20, 30, or 35 years, depending on what you selected at the time you signed the contract. Whole life is lifelong, so we consider that a permanent policy. Cash value for both. Term does not build cash value. Whole life builds cash value over time. Okay. Purpose. Term typically recommended for protection during key years, like we consider mortgage protection or income protection. And then whereas whole life, it combines an element of both protection and long-term financial planning. So which one is better? Well, here's the truth. Neither one is universally better. It all depends on your financial goals, budget, family situation, and long-term strategy. So some people prefer long-term purely for income protection. Others prefer permanent for long-term legacy goals. And in some cases, both actually make sense. If this breakdown was helpful, subscribe for more financial education. And if you'd like a protection strategy session, I'll include my consultation link below. I look forward to connecting with you soon.